all of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster.
Alrighty, everybody, what is going on? Welcome back to another CYPRX fundamental deep dive. I'm going to start right off the back by apologizing in advance in case I need to stop and hack out a lung. I'm like excessively sick right now. I'm trying to ignore it and not feed into the mental mindset of being sick. So like mentally I'm positive right now, but my physicality is like horrible. Didn't get any sleep. I have a fever of like 104 and I've been coughing up a lung every 5 seconds. So I got my tea here, I got my water here. So hopefully that helps keep my throat able to talk through this entire discussion. So in today's fundamental breakdown for you guys, I want to do a really thorough, updated XRP analysis, a forward outlook heading into the entire new month of August. I want to do a really detailed, educational, fundamental breakdown showing you guys everything that took place. You guys can see I have all of the annotations from the news events and articles that took place from June into July, what was creating support for risk assets, what weighed on risk assets, what we were talking about in the private CyPrX community. I have all the snapshots, all the screen shares that were fundamental drivers, either weighing on risk sentiment or supporting it. So that way you guys really truly understand what to be paying attention to and what to be mindful of as we roll over into August, painting a very clear picture for you guys as to where we currently sit in price action. So before we get into that real fast, why is it so important for people to pay attention to this? Why do we use the total cryptocurrency market cap? It's so that way nobody watching our content can say that we are biased against a specific asset. So that is why I use the total cryptocurrency market cap, but just to show you guys that you can do this pretty much with any cryptocurrency that hasn't had a substantial price appreciation because of something outside of fundamentals. So this is the total cryptocurrency market cap's price action. You can see the candlesticks, and then behind it, you have XRP's price action visible by this pink line. Okay. And so I just wanted to show you guys that the total cryptocurrency market cap mirrored XRP's price action. And so that's why it's so important. We understand the fundamentals because just like how back in May, when the market briefly topped out, you can see that XRP's price action also briefly topped out and started its decline. Here in the total cryptocurrency market cap, you can see that when the total crypto market on June 22nd bottomed out, this is when the ceasefire was announced between Israel and Iran. And we also had some dovish Fed rhetoric, support rate cuts. Well, that was the same exact time that XRP's price bottomed out as well, and we started to see price turn around. XRP's price went on a substantial rally and increased all the way up until about July 21st, 2025. Again, interestingly enough, it's the same exact time that the total cryptocurrency market cap started to pull back in price as well. And then most recently, this past weekend, you can see that the total cryptocurrency market cap had a nice little tiny uptick. Same thing with XRP's price. We've now had a nice, slight, small, decent recovery from last week's sell-off. So I just wanted to start off by showing you guys this correlation because a lot of people will stop watching these videos or click off on them because they're like, oh, well, I don't really care about the total cryptocurrency market cap. I want to be specifically focused on one asset. But realistically speaking, the total cryptocurrency market cap engulfs all assets and plays a very big role in analyzing these markets properly. So I just wanted to show you guys that. If you guys ever want to play around with this tool, you can always come up here and you can add different different pairs to layer on to see correlations or inverse correlations with this compare symbol tool up here in TradingView. So just simplistically for anybody that doesn't know how to operate TradingView, that's how I did that, right? So let's delete that and let's turn on all of the drawings that I have for you guys to go over today. So again, this is going to be very thorough, very educational. And this is, if you're new to this community, something that we do periodically pretty much towards the end of every single month, rolling over into a new month. We take a look back, where we're at, where we could head, what were key drivers of market sentiment, risk on, risk off, so that way we understand the landscape as a community. Um, and so that way nobody's confused and we really truly understand how to properly dollar cost average in. We understand the environment that we want to see before we deploy our capital into the market. We understand the environment that is being built if we're being patient and waiting and sitting sidelined while the market rallies, not buying into that hopium and that, price induced pump price action environment where people are saying, "Oh my gosh, you should buy now," FOMOing out, and then, getting wrecked when the market does pull back. It is imperative that you guys understand these conditions moving forward. So, before we do that, I always like to support our thesis and our claims here, both what myself and Scalper are providing for you guys with institutional research. So, here is a post. Can everybody hear me with this monotoned that I'm talking? I'm trying to talk real close to my mic. Does my volume sound good?
Sounds great.
Okay, because honestly, I might have to dim it down a little bit more.
Sound
So
good.
back on July 22nd, 2025, in the Cypress analysis section, shout out to the CYPRX researchers for this. I said to you guys here, what do the most powerful financial algorithms in the world do? They don't marry a bias, they react. So at CyPRX, we train our community to do the exact same. That's not by accident, it's by design. As shown in the International Journal of Research publication and reviews, March 2025, so this is updated info, the most advanced AI trading systems continuously learn and adapt. They detect anomalies in real time. They track macro data, sentiment, and geopolitical developments, and they react instantly to warning signs of liquidity crises, credit defaults, and volatility. And they can do all of this much faster than humans can, which is why we play both sides of the market, which is why we run these if-then scenarios and we try to understand the landscape and how risk assets could evolve depending on the fundamental backdrop. So when we tell you guys to stay flexible, to stay alert, and to adjust your positioning, it's not just trading advice. It's the same framework used by the largest quant desks and AI systems in the world. Ignore the noise, follow the data, and never fall in love with your bias because sentiment could change on the drop of a dime. So just to show you guys some of those snapshots, right? It says how due to automated trading algorithms, they react to abnormal market signals. AI-powered trading models operate at speeds far beyond human reaction times, executing trades based on preset parameters and evolving market conditions. AI-driven strategies, on the other hand, leverage machine learning algorithms that continuously learn and adapt to changing market conditions. Down here, it mentions that they gather their sentiment and sources, including alternative data such as social media sentiment, which is why we follow Twitter engagement, along with geopolitical developments. Then here it goes on to mention machine learning models process structured and understructured data, including financial statements, market sentiment, and geopolitical events. In addition to predictive analytics, AI enhanced real-time risk monitoring processes high-frequency trading data, news sentiment, and macroeconomic indicators instantaneously. And then here you can see this is that report that Break Free from the Matrix shared from the International Journal of Research, right? So that is why it's so important that you guys pay attention to these things. Now, these breakdowns, they're quite boring. Trust and believe that in order to go and gather all of these fundamentals, I had to go and sift through the Discord for over 2 hours this rising to piece this together for you guys. So trust me, I know it's boring, but it's extremely important to know why your portfolio is increasing or decreasing. And when you know that, for example, most recently, when the market was pulling back, you guys can see that the areas of interest that we had identified in previous Zoom calls days in advance had been hit. And so that gave us predetermined areas of interest as to where we want to deploy capital in. And so anybody that was deploying capital at these levels that we had anticipated days, if not weeks in advance, is now slightly in profit. Whereas vice versa, everybody that was buying into all of this hype up here when the market was at a top, thinking that they weren't never going to get another opportunity to dollar cost average in, chasing price pumps and price gouges and influencers that don't really put people in the right state of mindset, they're all still sitting in a loss. And in order for them to rekindle those losses, they need the market to appreciate back up into these higher levels. However, here in this community, we don't. We don't need that because we execute properly. we're patient, and we understand the market conditions and how they can change and how we can adapt to them to see a rising equity curve in the now and not have to wait for some substantial bull market to see price appreciation in our portfolio, right? So hopefully, again, you guys are tapping in. At the end of the day, not everybody needs to rely on these things because not everybody is a day trader. Not everybody is a DeFi investor. Maybe you're just a dollar cost averager. But as a dollar cost averager, hopefully your goal is to make money, not just to buy and hodl and hopefully make money long term. I know that you most likely came into this market just like I did, and that is to make money. So, me as a dollar cost averager and that portion of my portfolio, I like seeing my personal portfolio increase in value the day after, or 2 days after, or a week after I dollar cost average in, not a year after I dollar cost average in. That's just me. That's my approach. And this is how I've been able to do that. This is how I've been able to grow a 7-figure portfolio without putting 7 figures into the market. And it's by understanding these fundamentals, when to deploy capital and when not to. So, starting back in June, when we had this substantial sell off, all right, I'm going to refrain from asking you guys questions and just thoroughly break this down for you all to save time in today's recording. So, why did the market pull back substantially in June? I will ask these rhetorical questions, and I ask that you guys take it upon yourselves to try to answer them in your own mind as we go through this. So, why did the market substantially pull back in June? This was actually, hold on, before I even do that, let's make sure that everybody understands the backdrop. Why is this not? Hold on. Let's see if I can refresh it. There we go. First, let's understand key drivers of market sentiment. All right, so everybody understands our primaries. Now, keep in mind, this is not everything that dominates risk on or risk off sentiment, but here in this community, because we are in a headline driven environment, these are our primaries. Now, this does not include things like positive, what's the word? I don't know why I'm having a brain fart now. Positive regulatory clarity or negative regulatory clarity. This does not include black swan events that are unbeknown to people in these markets. Like, for example, if a stablecoin depegs or if there's negative regulatory rhetoric that dampens market sentiment, this list does not include that. This list includes geopolitical developments, tariff implications, data-driven headlines, FOMC, central bank policy decision, right? Economic dockets, data, things like that, right? So intraday fundamentals that we pay attention to day by day here in this community. So usually and historically speaking, because again, things could change. We have to remain adaptive. But historically speaking, over the past 2.5 to let's just say 4 years that we've been incorporating these fundamentals into the private CYPRX community breakdowns, these have been the key drivers for positive risk on assets outside of the tariff implications, which have been pretty much brand new ever since Trump became president last year in November, right? So FOMC meeting or meeting in minutes that signal rate cuts, still possible this year. Tariff-induced inflation, seen as temporary or modest. Trade war negotiations, lower tariffs solidified from major jurisdictions or trade extensions to give jurisdictions more time to work out deals. Inflation expectations remaining well anchored or inflation coming out lower than previously reported. I don't know who just drew on the screen, but that's really annoying. I know you probably didn't mean it. Let's clear that out. Okay. No fresh geopolitical escalations in the Middle East or Russia, Ukraine. Solid labor market and consumer spending, easing recessionary fears coupled with lower inflation that support a soft landing narrative, or labor market or US data that weakens the dollar and supports rate cut odds. Keep in mind that even though rate cuts are usually bullish for risk assets, if we see labor market or US data that weakens the dollar, it can spark recessionary fears. So short term, this could lead to an increase in demand for safe haven assets, but have a long-term bullish effect in risk assets as it usually prompts the Fed to cut rates. On the inverse side of things, what is usually negative for risk assets in terms of headline and data is hawkish surprises from Fed speakers, especially in upcoming labor market data, i.e. strong jobs or unemployment prints. Labor market data that comes out extremely downbeat, increasing the appeal for other safe haven assets like gold or yen, sparking recessionary fears, a breakdown in U.S. trade negotiations or bad tariff headlines, any resurgence and escalations in the Middle East tensions or military confrontation between Russia and Ukraine that sparks fear, uncertainty, and doubt, any signs of persistent inflation that pushes back on rate cut hopes, an unanchoring of inflation expectations, particularly short-term inflation metrics like core CPI or PPI month over month, weakening business investment or consumer sentiment that causes recession fears, that usually tends to have an increased demand for safe haven assets intraday, excessive strengthening of US data that leads to dollar strength, or any excessive yen strength due to upbeat Japanese economic activity, Bank of Japan rate hike, or hawkish Bank of Japan that leads to unwinding of yen carry trades. All right. So this has been our primary list, honestly, since outside of adding the tariffs, the beginning of 2024, end of 2023 timeframe. So we have really not changed this list week by week that we go over these things, and it's most likely not going to change anytime soon as we continue to remain in a headline-driven environment. So taking a look back at June, why did we see this substantial sell-off, and what led to price appreciation and the market finding a bottom in terms of fundamentals? If anybody recalls, back in the middle of June, we had the Israel and Iran conflict. As mentioned in the above list, Middle East tensions usually tend to weigh on risk assets because it prompts fear, uncertainty, and doubt and increased safe haven demand. Now, all of these timestamps and pictures that I have for you guys have dates because here in this community, dates are extremely important to us and timestamps are extremely important to us. So June 12th, 2025, you can see the headlines. Israel strikes Iran's nuclear site and kills top generals. Israel has launched a blistering attack on the heart of Iran's nuclear and military structure. June 13th, the day following. Major risk-off moves all around markets as Israel strikes Iran. Major risk-off moves all around markets as Israel strikes Iran's nuclear facility. The Middle East has experienced a significant escalation, right? And this led to a substantial sell-off in risk assets. This was a 12-day war escalation that took place, and we saw excessive demand for safe haven assets, and we saw excessive, inversely correlated sell pressure in risk assets as larger investors than you and I sought to de-risk their positions. Now, interestingly enough, if we go back and we look at May lows, really all the market makers were doing, because they manipulate these markets and they create these events, believe it or not, as horrible as it sounds, in order to give themselves reasons to move these markets so that way it doesn't just look random. Because what you'll notice is where the market bottomed out is exactly where the market makers were buying from aggressively back in May. So really, all the market makers were doing were giving themselves a discount and then buying price back up at a discount via uninformed retail investors that thought that we were going to go into a bear market cycle because they don't understand the underlying fundamentals. Sure enough, June lows were created on the 22nd of June, and this was primarily driven by supportive fundamental factors that flipped the sentiment from risk off to risk on. So asking the question to you guys, what were those factors? Let's take a look. Here you can see a fundamental report, multiple of them actually. June 25th, June 23rd, June 24th, all the week that the market turned around and flipped bullish, you can see Bitcoin has rebounded from a spike below 100,000 amid easing geopolitical tensions in the Middle East. ETH rallied 9% to $2,420 on June 23rd after Donald Trump announced a ceasefire agreement between Iran and Israel. Crypto majors recover alongside equities as ceasefire steadies risk sentiment. Recent ceasefire brings recovery after Bitcoin fell to $102,000 during a 12-day war. The total cryptocurrency market value hit rock bottom. And so on this day, when the market bottomed out, we saw a ceasefire announcement that, again, eased all the fear, uncertainty, and doubt that was created in this fear-induced environment when Israel launched the attack, which led investors with much more money than you and I to rotate out of safe haven assets, i.e. gold was at a new all-time high. Japanese yen was most likely strong. Dollar was most likely strong. They profit took from those assets and rolled that back into risk when risk was at a discount, right? As we continue, what happened next? So here we can see another fundamental. June 26th. Investors are betting on July rate cuts, and the rate cut bets increase as employment risks are trending higher. Markets are now pricing in a 92% chance that the Federal Reserve will have lowered rates by the end of September, up from 64% a week ago. So, as I mentioned in the above list, increased rate cut odds tend to support risk assets, right? And so that's something that we saw rolling into the new month of July at the end of June, supporting risk on sentiment. As we continue, U.S. rate futures rise as Powell leaves July cut on the table. Short-term U.S. rate futures edged higher after Fed Chair Jerome Powell stated that he can't say if July is too soon for a rate cut. The ambiguity, I hate that word. I told you guys I hate that word. Ambiguity, and I think I nailed it. Ambiguity keeps market hopes alive for a near-term policy shift, boosting dovish sentiment despite mixed economic signals. So you can see right here, I highlighted that key rhetoric. Dovish, right? Dovish tones or dovish rhetoric from any central bank speakers usually tend to support rate cuts. That therefore usually tends to support risk assets. And you can see the date, July 1st, 2025, right? Looking at where this is at, you can see Tuesday, July 1st, 2025, we saw an excessively bullish aggressive move to the upside. On top of that, what else did we get? July 2nd, 2025. This is now Wednesday, okay? We had Jerome Powell speak at the FOMC, and Fed sounded a lot more dovish. Here's that key vocabulary word right there. Fed Chair Jerome Powell said July interest rate cuts were not off the table. Powell confirms that the Fed would have cut rates by now if it were not for tariffs. This is a dovish comment. You can see the date, July 1st, 2025. So again, I'm just trying to show you guys that our list of supportive fundamentals for risk assets held weight at the beginning of July, which is why we saw such a substantial rally on July 1st heading into the new month. As we continue, what else supported risk on sentiment? Well, here we can see on July 3rd, we got, again, the first week of every single month, either Thursday or Friday, depending on the holiday calendar, we get labor market data. Well, the labor market data that we got for June in July supported the odds of increased rate cut probabilities. On July 3rd, the U.S. non-farm payrolls for July were only 73,000 far below expectations, and the data for May and June were significantly revised downward. Furthermore, Federal Reserve Board Governor Kugler will resign next week, allowing Trump to appoint a preferred candidate early. Perhaps the influence by this news, the probability of a 25 basis point Fed cut in September surged to 80% on the CME Fed Watch indicator. Before the NFP, this figure was only at 41%. So how many times have I gone over in Zoom calls when this rate cut probability increases above 50%, it usually tends to reflect itself in a risk on sentiment. And you can see that that probability surged to 80%. If we look at the data and we look at that coupled with price action, you can see here, this was Friday, July 4th, when the data came out, right here in this area. Markets pulled back, found support, data came out, supporting rate cut odds, boom, markets continued to rally, right? As we continue, what happened next? We have Wednesday and Thursday, July 9th through the 10th. Looking at the data, continued risk on sentiment, supported by fundamentals. We had multiple Fed speakers come out and speak that day, coupled with the Fed meeting in minutes. Now, remember, the meeting in minutes is a report of all the Fed comments and their roundtable discussion from the FOMC meeting the week before, right? So we got that the week following, July 9th and the 10th, and you can see it here. Most Fed officials see rate cuts coming. The minutes of the Federal Reserve Open Market Committee. Now, if you guys remember, in a Zoom call, I have that screenshotted for you guys here. We broke down in detail. Here's our screenshot from our Zoom, July 9th, 2025. We broke down in detail at about 17 minutes and 40 seconds into this Zoom call, and we read the entire FOMC meeting in minutes. I remember highlighting everything for you guys, explaining why we were seeing a risk-on sentiment in that environment, and you can see even in our highlights, in the FOMC meeting in minutes, they even mentioned that they're seeing an improvement in risk sentiment. You can see that highlighted right here, twice. This is again our meeting back from July 9th. So heading into mid-July, we continue to see a risk-on rally. Dovish Fed rate cuts being priced in aggressively to the market in September. We had easing Middle East tensions, dovish Fed rhetoric down here, Bitcoin recovering after the aggressive attack from Israel and Iran, and all of that coming into fruition. Market sentiment flipped bullish. As we continue, the day after, July 10th, here you can see yet again another Fed speaker, July 10th, 2025, prompting dovish Fed rate cut signaling. Fed Waller said it's not political. Waller again calls for a rate cut in July. So the market continued to aggressively price in a high probability that rate cuts could happen in July or September. As we progress and we start to roll over towards end of July. Let's expand these up. All right. So this is July 13th, 2025. So let's look at the date. Here's July 13th, 2025 right here and price action. What created the substantial continuation in market movement? Well, we had positive trade negotiations and announcements between the US and the EU. July 13th, 2025, it says, the EU delays retaliatory measures against the US in hopes of reaching a deal by August 1st after Trump announced a 30% tariff. The European Union will extend its suspension of retaliatory measures. This is a positive statement on the US, which were set to take effect in coming days, in an effort to continue negotiations and hopefully procure a deal with the Trump administration before the US starts charging its higher tariffs on August 1st. Right? So you can see the rhetoric, the vocabulary is positive, and the market reacted net positive to that. We continued to see a supportive risk on environment, and the market continued to trend upwards, creating higher highs and higher lows. This is again July 13th. Right? So there's that foundational support right there. Market came back, retested that, buyers defended. But why did they do that? Why, when this market pulled back slightly here and buyers right here, okay, you can see sellers started slightly showing their hand, buyers slightly taking profit, sellers most likely got trapped in positions down here in this area, buyers aggressively re-showed their hand and defended prices and came back in. But what fundamental backdrop was creating this continuation in bullish sentiment as we rolled over into the end of July? Let's again take a look. July 15th, right? So you can see the date right down here. It was a Tuesday, July 15th, that the market pulled back into a discount, bottomed out, created support at $3.6 trillion, which is one of our key areas of interest for this recent pullback. What was taking place on July 15th? It says right here, the Federal Reserve will likely be able to start cutting short-term borrowing costs by September. Traders continued to bet on Tuesday after a government report showed a widely expected increase in consumer prices last month. The market is pricing in the probability of a Fed interest rate cut by September, and that remained around 60%. So that's still above the 50% threshold that we pay attention to, right? So sure enough, because the market continuously priced in rate cut odds, that supports risk assets, and we saw that reflected in price. Here is a message from Thursday, July 17th in our private CYPRX Discord, where I gave you guys a full report and update from the tariff announcements between Japan and the US. And I said here, Japan and US tariff updates. Both jurisdictions spoke today. No deal yet, but negative headlines have not dropped either. Markets will likely still remain hopeful that a deal can be reached. I highlighted that in yellow for you guys, right? Why did I highlight that for you guys? Because again, this is myself in an attempt to show you guys, talking you guys through fundamentals. On July 17th, I told you all that nothing negative had been announced and the market will most likely remain hopeful that a deal can be reached. So what did the market do? It continued to price that in, and we continued to see a risk-on rally. Here you can see it says Thursday, we hope to continue efforts to reach an agreement within the August 1st deadline as a milestone. And this is them talking about this here in this area. So keep in mind that the markets price these things in when conditions are hopeful for something in the future. So the markets, what were they doing all of July? They were pricing in rate cuts. They were pricing in Fed dovish rhetoric. They were pricing in hopeful negotiations between the EU and the US. in the Japan and in the US, right? And that was creating a favorable market environment. Then, once we got to the end of July, rolling into the beginning of August, market sentiment started to shift. We started to see profit taking. We started to see sellers showing their hand, and we started to see this deep retracement down into that 3.6 threshold that not only did we identify in advance for you guys, which I'll show you in just one second, also called out the local top for you guys, but how we were able to identify that area, because looking back at historical data here in this area, these dates, July 15th, linked up with fundamentals in order to create this supportive environment where buyers were able to come in and defend. So on Tuesday, the 15th, when the market defended at $3.6 trillion, it aligned with fundamentals. So in the future, when I was giving you guys these pullback targets, it's because I was aligning them not only with technical analysis support, where buyers were defending aggressively, but also where fundamentals were supporting a risk on sentiment before, right? So let's go over the backdrop rolling into the last week of July. Excuse me, the last, let's say, 1.5 weeks of July, rolling into the beginning of August. What took place? Why did the market roll over? What were we discussing and talking about ahead of the curve? Always trying to give you guys an advantage, both myself and Scalper. And what were we taking a look at? And how were we analyzing things? What created this market pullback? And where are we at now? Right? So taking a look first here. Let's open this up. Here this says Tuesday, July 22nd. Remember, timestamps are extremely important. Okay. So Tuesday, July 22nd, in the fundamental update section, I said to you guys, Japanese US deal might not be the juice that the market needed, especially if it gets downplayed. Then I said, ooh, maybe this data is priced in already. I'm liking this lingo. It could catch people off guard and we could get a pullback. This is again a message that I sent you guys July 22nd. Well, if we go look at the charts, July 22nd was Tuesday, exactly when the market topped out. I had mentioned to you guys that the market could possibly pull back under the conditions that were being met, that most likely prior to this announcement, all of the positive negotiations between the EU, US, Japan, and US were likely being priced into the market ahead of time. And sure enough, we can see, what does the data say? The deals are providing some boost to market sentiment on the ground, that worst case tariff rates have been avoided, but shares markets have already rallied sharply to new highs in many cases. So a lot of the good news is already factored in, right? That's how I was able to call out this top for you guys in the chat, right? It's not guessing, it's strategically planning and understanding the fundamental backdrop and knowing that if something's already priced into the market, when the news actually comes out, it's going to affect a buy the rumor, sell the news event, where just like in price action, if there's a rumor that in the future, so let's say, for example, so people can understand this, if this is the future, this circle is the future, somewhere in the future, right? And before this future event takes place, the market is pricing in the probability that the US and the EU or Japan and the United States will have a positive trade deal, and that's creating positive intraday market sentiment because the market's pricing that in. Well, when we actually get to that future event, boom, and the news comes out and it's positive, but what the market was already expecting, then everybody that was already pricing that information in, buying at these lows, is going to do what? Uneducated retail investors that think that the market's going to continue to go up from here because of the news are going to get trapped in buy positions. But real informed investors are going to take profit from their positions and they are going to discount the markets and sell. So this is a buy the rumor, sell the news event. And then the market's going to find some support where previous aggressive buyers existed. And everybody that is uninformed is going to think we're turning into a bear market. But in reality, it was just a buy the rumor, sell the news event. Market then finds some support, stabilizes, catches all the uninformed retail investors off guard, and continues its uptrend, which is exactly pretty much what recently happened, right? So I'm just trying to show you guys a full example of that. Okay, so as we continue, let's look at what happened next. So here we can see this is a Wednesday, July 23rd update, so the day after, and I told you guys in full detail why the tariff rhetoric triggered a risk-off shift instead of a positive shift, and I broke that down for you guys in detail here in this paragraph. So I'm just trying to show you guys that the day after the market pulled back, after I called it out for you guys in this post here on July 22nd, I broke that down for you guys in detail in the chat, why that took place. Market slightly recovered, found some support. This is where we dollar cost averaged in at $3.7 trillion. I remember specifically mentioning to you guys that our first area of interest had been met, which was 3.7. We saw a nice little tiny rebound in our portfolio, but then, okay, then on Sunday, July 27th, when we had our Zoom call, you can see here, this is a July 25th Zoom call that we had. And we had anticipated in this Zoom call recording on July 25th that the market was likely going to continue to pull back down into $3.6 trillion. Here's that Zoom call where we had anticipated that area of interest. Here are those two highlighted areas from the July 15th support that we saw. And I had anticipated a pullback down into 3.6. That's not the important part. The important part is the education that we gave you guys. So here is a report from July 27th, where I said, despite today's announcement of a principal trade agreement between the United States and the European Union, the total cryptocurrency market cap has failed to break higher into price discovery. This lack of momentum, despite seemingly bullish headlines, should not be overlooked. At the time of writing, the total cryptocurrency market cap is hovering around 3.91 trillion, the same level that we saw last week. We need to be careful in case momentum stalls out here. The market may need more than just diplomatic progress to drive another bullish leg, right? And this is, again, another top that we called here in this community, July 27th, Sunday, 2025, right? Rolling over into July 30th, we can see here, one of the primary reasons that we started to see some aggressive profit taking of risk assets like crypto was due to dollar strength. That last week in July, I believe this was a Tuesday, if I'm not mistaken. Maybe it was a Tuesday. I think it was. Yeah, it was a Tuesday. July 29th, we had U.S. consumer confidence data come out, and the index rose to 97.2 in July, which is one of its highest readings in months. The U.S. Consumer Confidence Index rose in July, and the U.S. dollar index climbed to a 5-week high. So remember, we mentioned in the data here on this list, something that can weigh on risk assets, let's see, is any data that comes out extremely aggressive or strong that pushes back on rate cuts. Any data, it says right here, excessive strengthening of U.S. dollar or data that leads to dollar strength. Right? And we got that data. Now, not only did we get that data, but if you take a look in our community, what we were sharing, look at this, Monday, the day before, right? So keep in mind this report here that talks about dollar strength on the 29th of July. The day before that, I'm always trying to show you guys that we pay attention to what banks are talking about. Well, the day before that, look at this, Monday, July 28th, in our community, I was sharing this ING report from a bank for you guys, and it says here, the announcement of the US and EU trade deal has lifted equity futures on both sides of the Atlantic. Investors were more worried about a bubble now than a recession. The deal takes some pressure out of the August 1st tariff deadline and shifts the focus back to very busy weeks of macro data. Here, we think the Fed meeting and inflation and jobs data can support the dollar. And I specifically remember highlighting this in red for you guys because we reiterated that any dollar strength could possibly weigh on risk assets. And this is from the 28th. So the day before the market pulled back and before the dollar strength started to excessively increase, we'd called that out for you guys and gave you guys bank reports to pay attention to. And I remember hosting a Zoom call on this. So one of the primary reasons why the market started pulling back, this recent pullback, is because of dollar strength. So now we're starting to look more at the recent pullback. Okay. So far, right? End of July, rolling into the beginning days of August, we had Markets already pricing in EU and Japan US trade deals. So because that was already priced in the month of July when the news actually came out, investors took profit. Couple that with upbeat US data that strengthened the dollar. So far that's what we have rolling into the end of July, into the beginning of August. Let's see what else we have. Here's a report from July 29th, where we had talked about investor focus should now shift to Wednesday's Federal Reserve policy decision, followed by Fed Chair Jerome Powell's press conference. While the Fed is widely expected to keep interest rates on hold, market participants will be watching closely for Powell's tone and any change in guidance around inflation, the labor market, and potential rate cuts later this year. And I specifically highlighted in bold. A hawkish or cautious message, especially if Powell pushes back on rate cut expectations, could drive further dollar strength and lead to aggressive profit taking across risk assets. This is again a report. You can see the date, July 29th. So if we look, July 29th was here in this area before the market had substantially pulled back when we started to see dollar strength increasing because of the upbeat consumer confidence index. Sure enough, shortly after that, the day after, what did we get? Says it right here. Chair Powell put a hawkish spin on things, leaving a September cut as a coin toss. Right? So Jerome Powell came out at his FOMC meeting, slightly more hawkish than the market had anticipated. You can see here, what did that lead to? Despite two governors' dissent from the Fed's decision to stand pat, the market took away a hawkish message. U.S. rates rose, the dollar rallied, and stocks were sold, i.e. risk assets were sold, right? And we had talked about this the day before it happened in our report from July 29th as an indicator here, warning you guys that that could be a possible scenario, right? So far, profit taking because of the priced in trade deal between the EU, Japan, and the US. Upbeat US data supporting dollar strength. Then we had a hawkish Fed pushing back on rate cut odds, which were already priced into the market in June and July. Now being dialed back created some excessive dollar strength. Let's look at this. We can get rid of. I want to show one of Scalper's posts here because I got to give a shout out to Scalper. He continued to reiterate to you guys as well some similar things. So I don't think I have that one on the charts, but I got to give credit where credit's due. Let's see. Oh, it says the image is too large. Okay, well, Scalper had also mentioned to you guys that we could see some possible profit taking. He mentioned that on August 1st when the market was here in this area, right? So moving on, heading into Friday last week, why do we see the substantial drop and decline in price even though we saw a bad NFP report? Okay, so remember in this list, I mentioned to you guys that even though we see a bad NFP report, okay, it says right here, labor market data that comes out extremely downbeat, increasing appeal for other safe haven assets like yen or gold. Even though this data, because up here, it can contradict for the positive risk on tone, it says labor market data that weakens the dollar, which it did on Friday. We saw an aggressive sell-off in the dollar strength. And we saw the data, i.e. the fundamentals, labor market, NFP, and unemployment rates support the odds for a Fed rate cut. And most influencers and traders and investors out there would think that that supports risk assets. And it does, but long term, not intraday short term. Why? Because intraday short term, it sparks fear, uncertainty, and doubt. And fear, uncertainty, and doubt, i.e. recession fears, usually tends to see an increased demand intraday for safe haven assets. And that's exactly what we got. And I write that for you guys in these reports. So I said here in bold, keep in mind that even though rate cuts are usually bullish for risk assets, short term, this could lead to increased demand for other safe haven assets, which is exactly the environment that we got on Friday. So if we look at our Friday reports, Here you can see we talked about this. Gold surges to $3,350 on Friday after a weaker than expected U.S. non-farm payroll report triggered a broad U.S. dollar sell-off and revived expectations of September interest rate cuts by the Federal Reserve. So most people would read this and be like, well, what the heck? Interest rate cuts usually support risk assets. Why did risk assets on Friday sell off? It's because gold and yen were much stronger. You can see here's a snapshot of gold's price action. It completely surged to $3,363 per ounce. And then if we look at the backdrop on the yen fundamentals as well, you can see it says the same thing. JPY outperforming as safe haven demand returns. The Japanese yen appreciated by 0.2% against the US dollar, outperforming all G10 currencies in a classic risk-off move according to Scotiabank strategists. And you can see the strength of the Japanese yen. So dollar sold off because of downbeat NFP figures supporting rate cut odds, the aggressive misprint in the unemployment, right? And the NFP figure sparked slight recessionary concerns. That usually tends to increase fear, uncertainty, and doubt, which then therefore leads to safe haven demand, not aggressive risk on demand. Even though rate cuts eventually are bullish for risk assets, intraday we saw the sell-off. And where did that sell-off lead us down into? Directly into the $3.6 trillion level where market makers were aggressively buying back here in this area during all of these fundamentals that supported risk assets, right? So in this community, we were telling you guys not only $3.6 trillion in previous Zoom calls as our first area of interest and targets, but now rolling over into our XRP analysis because our XRP analysis was extremely accurate, right? So before we get into that, we take a look at picking up where we left off in our previous analysis from August 1st on XRP, when we had called out $2.75 as our next bearish targets on XRP. Let's just take a look at why the market is starting to rebound today. So there's been two fundamentals that I've seen favor risk on sentiment from yesterday and then today. One of them being positive trade talks between China and the United States that took place yesterday. So China's trade deal under discussion after Washington has positive talks. I highlighted that in blue. Blue or green, always trying to keep you guys in psychology realms, right? Blue positive, green positive. With Beijing, U.S. trade rep says. But down here, I highlighted this in red because this is an indicator for us. It says right here, U.S. tariffs on China could snap back above 80% if a deal is not reached by the current August 12th deadline. So keep in mind, in the coming days, if we see trade rhetoric start to sour, if we see right now the market is starting to price in the possibility of positive talks coming into fruition, but then the talks start to dematerialize and break down and the tariffs increase back up above 80%, that's probably going to deteriorate the market sentiment that we're currently seeing today. So just be mindful of that and be prepared. Also, what else are we seeing? Well, just like I said, NFP, downbeat jobs data that supports rate cut odds usually does tend to support risk assets, but intraday, the day of that it comes out, it does not. So here you can see a report from Fox, August 4th, 2025. This was updated 7 minutes ago when I took the screenshot. It says, most stocks bounced back on Monday as hopes for U.S. interest rate cuts rose following a sharp slowdown in jobs growth that raised concerns about the world's top economy. So remember, when there's fears about the world's top economy, like the United States, the day of that those fears are implemented into the market, we usually tend to see intraday demand for safe haven, which is what we got last Friday, which is why risk assets, even though there's a supportive backdrop for increased rate cut probability, we still saw aggressive selling and restructuring of markets. The broad gains follow a sell-off on Wall Street last Friday in a reaction to the weak jobs data and news that dozens of countries would be hit with U.S. tariffs ranging from 10 to 41%. So right now we're seeing increased probability of rate cuts from the Federal Reserve, and we're seeing positive trade negotiations support this current risk on recovery. Now we're not seeing anything aggressive yet, right? So even though we're starting to slightly see either profit taking from sellers or starting to see buyers defend at previous positions, this current momentum has not been enough to engulf all of this previous sell pressure. So where does that leave us moving forward, right? Going back to this list as we head into August, we can now place this over here and we can start to delete all these things and we can start to do a forward outlook, right? So doing a real quick forward outlook and then rolling over into XRP's price action. If we want to see price action hold this level as support, we want to see price action continue to rekindle gains from last week. And we want to see a higher market cap in crypto. We need to see these risk on fundamentals take place in the month of August. FOMC meeting or meeting in minutes signaling rate cuts still likely later this year or in September. Tariff-induced inflation seen as temporary or modest. Lower tariff, or excuse me, well, we could say lower tariffs, but I was going to say lower inflation readings and the CPI, PPI, core PCE readings that we get in August, right? Trade war negotiations ushering in lower tariffs solidified from major jurisdictions or trade extensions to give jurisdictions more time to work out deals. Inflation expectations that remain well anchored. No fresh geopolitical escalations in either the Middle East or Russia, Ukraine. Solid labor market and consumer spending backdrop that eases recessionary fears, coupled with lower inflation that supports the soft landing narrative. Labor market or U.S. data that weakens the dollar and supports rate cut odds. Again, keeping in mind that temporarily that could lead to a demand for safe haven assets. Long-term bullish recovery, though, for risk assets. So if we want to see something like this, it's possible, but we have to be realistic. We need to see supportive fundamentals, just like we saw all throughout the month of July, if we want to see higher prices. And as of time of recording this video breakdown, the two fundamentals that I just showed you guys are not enough to see aggressive buyers substantially overpower all the sellers that exist in this area, right? Inversely, if we're to see the negative side of things, we cannot break into new highs, meaning this holds as resistance. The market sentiment sours. This buy pressure dies out. Sellers start to aggressively defend, and the market sentiment sours. It could again open the door for a deeper retracement. We don't know that that's going to happen yet, but is it again plausible to speculate on, especially if the market sentiment starts to shift and we start to see more hawkish rhetoric from Fed speakers? Labor market data that comes out, extremely downbeat, increasing appeal for other safe haven assets. A breakdown in U.S. trade negotiations or bad tariff headlines, like, for example, the 80% tariffs that the market's possibly anticipating if trade talks sour between China and the United States. A resurgence in any Middle East escalations and tensions or any military confrontation that demands safe haven appeal. Signs of persistent inflation that pushes back on rate cut hopes, right? So if we get CPI and PPI data in August, coupled with core PCE that all comes out higher than the market's anticipating, showing that inflation is still sticky and troublesome, that's going to diminish the odds of those rate cut bets in September, right? Weakening business investment or consumer sentiment that causes recession fears, leading to safe haven demand. Any excessive strengthening of U.S. data that leads to dollar strength, excessive yen strength due to upbeat Japanese economic activity or the Bank of Japan rate hike, or any hawkish Bank of Japan rhetoric that leads to aggressive yen strength. Well, that is most likely going to lead to a scenario like this, right? We don't have some crystal ball, but based off of logic, based off of previous fundamental analytics and how the markets move in a risk on or risk off environment, it's logical to think that this is the most likely scenario based off of these releases, right? So moving forward, again, we'll do a quick overview of more immediate price action, just taking a look at this week. But real fast, briefly going over XRP. All right, so let's go take a look at XRP. Keep in mind, this is the Zoom call that we had August 1st, 2025, where we had called out these targets, $2.75. You guys can see we don't pop smoke here in this community. We don't do any outrageous targets. I personally bought some XRP that is currently now in profit. Not for my long-term bags or anything like that, just specifically XRP that I'll be using in the DeFi ecosystem. I think I put like $1,000 in, and I think it got me like 280 or something XRP or something like that, right? It wasn't a big bag. It was just like $1,000. Okay. Nothing substantial, but it's now in profit. It's now worth more because why? We bought when the market was fearful. We bought when the crypto fear and greed index was below 50. We bought when the risk sentiment was risk off, and we bought when price was at a delta. If you do those things, you're most likely going to see a rising equity curve in your portfolio a few days after, right? Instead of just buying XRP and hodling and hoping, or any other digital asset in your portfolio and hoping for long-term price appreciation, use these fundamentals and the metrics that we give in this community to situate yourself on the right side of the market, being patient and waiting, allocating to the digital asset space when the time is necessary. So moving forward, just taking a look at some targets. Ideally, what we would like to see this week, right, is we would like to see buyers show some support at 294 to 275, and we would like to see a continued risk on backdrop. So a slight retest of 294, considering that we've just recently broken above that. Buyers defending, sentiment continuing to improve, is going to open the door for a revisitation of 327, which we can clearly see buyers made a failed attempt to break above twice, once here, back on July 24th, and again here on July 27th. In order to see higher XRP prices, we need to break above 327, retest that as support, see positive fundamentals, and that could open the door for a revisitation of 359. We're going to take this level by level for now. 327 is our next area of interest. If we can break 327, that'll open the door for 359. I can't stress the importance of not overly expecting high-end XRP price targets, because keep in mind, institutional scalper has shared these deltas that sit at 444 and 517, which means that there's institutional sell orders that sit at these levels. So I'm not knocking a higher XRP price target, but it's logical to assume that if XRP price comes up into these levels, we're probably going to see sellers defend at these positions. So it's going to probably lead to some profit taking and buys and some type of pullback. Right? So these are levels to keep on our radar if fundamentals support a continued risk on sentiment in August or in September. But for now, we need to see buyers overpower aggressive sellers that have existed at these most recent levels, which are 327 and 359. Right? Since I just recently bought XRP at $2.75, that's now my discounted area. So in order for me to buy aggressively XRP again, I need to see prices go lower, which means for me, the next area of interest on XRP where I will be dollar cost averaging in is if we revisit $2.75, meaning I can get back in at where I just most recently bought, or if we see sentiment sour even worse, we see a break below $2.75, a retest to the downside, a failed attempt by buyers to break higher and make a recovery. That could therefore open the door for 242 as our next bearish targets. So for me on XRP, I will not be buying anymore because I just recently bought at 275 unless we can see a revisitation of 275, or excuse me, we can pull back down at a 242 under worsening market conditions, which in my personal opinion, again, would still be a healthy retracement from the overly extended July move from A to B. Taking a look at this week, key areas to monitor. Number one, tariff negotiations. We need to be monitoring for any escalation or failed talks that could fuel further safe haven demand. Any Fed speakers that we could possibly get. Holy shit, that scared the fuck out of me. Hold on.
All my prettier once it's all buried.
Any Fed speakers this week? I believe we have a multitude of scattered Fed speakers all throughout the week. So we were going to be paying close attention to the policy remarks post NFP to gauge the Fed's true stance, right? So I believe that kicks off tomorrow. We have a couple of different Fed speakers. So just be mindful of that. This week, we also have the ISM services PMI figures. Right now, the forecasts are set to show the strongest services growth in 3 months. So we know that if we see strong PMI figures, it's most likely going to lead to some dollar strength. Not saying that that's going to lead to a sell-off in risk assets, but it's most likely going to keep risk assets subdued. We're probably not going to see any aggressive buying if we see aggressive dollar strength. Factory orders, also on the US front, are expected to fall by 5.2% in June, reversing May's 8.2% surge. That could add pressure on the dollar. And we also have major earnings reports from businesses and organizations like Disney, Uber, AMD, Pfizer, and Eli Lilly. And that sentiment could hinge on forward guidance and macro commentary. So just be mindful, right? Ideally, if we want to see a positive risk on sentiment, we need to see upbeat earnings reports. Inversely, if we see any downbeat earnings reports or misprints, that could weigh on market sentiment, i.e., stocks. Usually, when we see sell offs in stocks, it usually tends to reflect itself in sell offs in other risk assets like crypto. Right now, even though the rate cut odds are now higher, this alone may not be enough to spark an aggressive risk on rally. If yen and gold continue to gain traction, crypto could face more headwinds. Investors may opt to stay defensive, particularly if upcoming data remains soft and trade tensions persist. To shift the mood back to risk on, what we ideally need to see this week is we need to see a cooling in safe haven demand. We need to see a reduction in tariff uncertainty. And we need to see data this week that is enough to justify rate cut bets, but not so weak that it fuels broader macro fears. And then on our radar as well is the Bank of Japan. So while not an immediate threat in August, we should keep an eye on the Bank of Japan. If the Bank of Japan moves to hike rates later this year, it could drive additional yen strength and unwind the yen carry trade, posing another potential headwind for crypto and other risk assets, as there's most likely billions, if not trillions of dollars invested into risk assets of borrowed yen, right? So just be mindful of that. As of now, the total cryptocurrency market cap, as I mentioned, this is from our other day report. This is from August 2nd, so 2 days ago. I said the total cryptocurrency market cap seems to be holding support at 3.6 trillion, but the landscape remains fragile. If the current risk-off environment persists, a deeper retracement down to July lows around 3.2 to 3 trillion is possible. However, I remain optimistic that crypto will find its footing after the short-term pullback, especially if upcoming macro data or geopolitical developments ease pressure on safe haven flows and reignite investor appetite for risk. So, recently, I dollar cost averaged in. In the chat, I let you guys know into what assets I was dollar cost averaging into. I gave you guys a basket of assets that I was putting about $5,000 into, spread out between those assets. I did not give you specific levels, as I told you guys that I would save those specific levels if we see a deeper retracement down into July lows at our next area of interest, which is going to be that 3.2 to $3.3 trillion range, right? So if we do see the market drop down into those levels, I'll give you guys specific DCA levels that I'm looking at. But for now, at 3.7 and 3.6, I just flooded the markets with about 10 grand spread out between different assets that I'm going to be using for my staking portfolio. Like I primarily focused on big ticket items like Solana. I think Solana dropped down to like 150 or 155 or something. I copped a lot of Solana, AVAX, the higher ticket assets that are blue chip assets that are a little bit more on the expensive side is what I focused on recently in this most dollar cost average that I deployed. So outside of that, that is the full analysis where we currently stand in the landscape. Hopefully now you guys understand what happened in June. You understand what happened in July, and you understand why we saw this recent pullback, and you now understand what to pay attention to moving forward. Keeping in mind that just because we've seen this slight market recovery does not mean that we're in full-blown recovery mode. We need to see continued supportive fundamentals this week. Couple that with price action, a break above these sellers, creating some support, continuing to track higher with a supportive risk on environment. And if we don't get that, then we have to assume that the most logical path of least resistance is going to continue to be skewed to the downside. So don't block out a possible continued depreciation in prices, but then at the same time be reactive in case the market continues to go up. All right.